Hello and welcome to our discussions on accounting, and today the focus of our discussion is accounting for derivatives, and under accounting for derivatives we'll see some examples on cash flow hedging and so when we say accounting for derivatives, the derivative, we have to understand what are derivatives and what are the relevant accounting standards for the derivatives. The derivatives are another financial instrument. Since derivative is a financial instrument, the accounting for derivative is also governed by the IAS 39 and for India Ind AS 39. So the treatment of derivative is just like any other financial instrument. The treatment is, in the initial recognition, all derivatives should be recorded or should be recognized at the fair value, like most of the financial instruments. And the subsequent recognition, in case of financial instruments, the subsequent recognition depends on the classification. So is the case with the subsequent recognition of derivatives. In case of derivatives, the subsequent recognition depends on the purpose for which the derivative contracts are entered into. Some derivatives may be because of speculative nature, or they are called held for trading. The others are called held for hedging. So in case of held for trading, the initial recognition is same, but the subsequent recognition is the changes in the fair value of the derivative will be transferred to or recognized in the income statement. But in case of hedging or held for hedging derivative, they have to follow hedge accounting. So what is this hedge accounting? How different is hedge accounting from other accounting for financial instruments is a focus of our discussion. So hedge accounting is actually a technique that modifies the normal basis of recognizing the gains and losses associated with a hedge item and hedging instrument. What does that mean? The gains and losses, that means you come across, you will, whenever there is a hedging, so there is a hedge instrument, there is a hedge instrument or hedge item and hedging instrument. So there will be gains and losses here. Okay, so the gains and losses in the changes in the value of the hedge item, and there will also be a loss or a gain in the hedging instrument, and the loss or a gain of a hedging instrument, okay, of a hedging instrument. So this is the major difference, that in case of a hedge accounting, so we try to match the gains and the losses from the hedge item with the gains and losses from the hedging instrument. So that is why the hedge accounting modifies the normal basis of recognizing the gains and losses on the hedge item, so that the incomes in the income statement in the same period, the gains and the losses due to the hedge item and hedging instruments are shown. But before we get into the accounting for it, it is useful to understand the different types of hedge. And the different types of hedge are either it is a fair value hedge, where you try to hedge the changes in the fair value of the hedge item. The fair value of the hedge item keeps on changing, so the hedge item becomes volatile, and as a result income statement is affected. So hedge item, the fair value of the hedge item can be protected by taking a fair value hedge. Sometimes the hedge is also for cash flow, for reducing, managing the volatility in the cash flow of the hedge item. So in that case, called cash flow hedge. Or in the third situation is called a net investment hedge, is a hedge of a foreign currency exposure arising from the reporting entity's interest in the net assets of foreign operations. So therefore, there are three types of hedges. One is a fair value hedge, the other is a cash flow hedge, the other is a net investment hedge. So the accounting for hedge or hedge accounting depends on what is hedged, what is a hedging instrument, the effectiveness of hedging, and the types of hedge. Now let us see the accounting for that. As we have already said, that accounting for hedge is a type of a derivative accounting, and the derivative accounting is governed by IAS 39 and Ind AS 39. So there is something called initial recognition and subsequent recognition. Initial recognition, the fair value hedge has to be recorded at the fair value. But the subsequent recognition, any gains or the losses arising from remeasuring the derivative at the fair value are recognized in the income statement immediately. To summarize, in case of a fair value hedge, the changes in the fair value of the hedge item is transferred to income statement immediately, and the changes in the fair value of the hedging instrument is also transferred to the income statement immediately. So that means in case of a fair value hedge, the incomes and the changes in the value or the gains and the losses arising due to the changes in a value of hedge item and hedging instrument are transferred to the income statement immediately. Whereas in case of a cash flow hedge, there's a slight difference. The difference is, I'll remove ineffective portion now. In case of cash flow hedge, the gains and the losses arising from the remeasuring the derivative is not transferred to the income statement, immediately. It is transferred to the equity, is transferred to the balance sheet. But later on, it is retransferred to the income statement when the hedge item affects the income statement. In this case, both are transferred to the income statement immediately, whereas here it is transferred to the income statement when hedge item affects the income statement. Similarly, in case of a net investment hedge, the gains and losses are transferred and recognized in equity, and they are retransferred when the foreign operation is closed or liquidated or disposed of. So the hedge accounting is different in case of a fair value, cash flow, or a net investment hedge in the form of the transfer of the gains and the losses either to the income statement or to the equity, and then retransfer to the income statement. Let us take an example to understand that. Suppose on 1st September A Limited anticipates to purchase 1000 metric tons of metal X. It's not an actual transaction has not happened. It's an unrecognized transaction. But was concerned about the price rise. So that means this transaction or anticipated transaction is a hedge item, can be hedged. To hedge this risk, the risk of the cash flow, if the price change, cash flow may change. To hedge this risk, it enters into a derivative, a futures contract, to purchase 1000 metric ton at the rate of 1000, and this contract will expire on 31st January. So till 31st January, A Limited can buy the goods at 1000. The price information on 1st September, the date of forward contract entry 1000. On the balance sheet date, the price went up to 1200, and the transaction rate, the price remained at 1200. And actual sales, these goods which they purchase, are sold on 5th June after adding some value for 2 million. So let us understand this contract. So there is a futures contract, and the futures contract gives the holder the right to purchase at any time during this contract period for a specified at a specified price. It is a derivative because the value of that derivative depends on the price of the metal, and if the price of X goes above 1000, the value of the futures contract will increase, or A will stand to gain, because A will be able to purchase X at a lower price per ton. So the accounting, if you want to see the accounting, we have to do accounting on 1st September, we have to do accounting on 31st December, 31st January, and 1st June. On 1st September, the value of derivative is 0 because the price and the futures contract value is same. On the balance sheet date, we have to revalue the derivative, find the change in the value of the derivative. So what happened to the no effect on the income statement and the cash flow. So the value of the derivative now, the price, the old price, okay, I'm not writing the dates, okay, let us put the dates, no problem. The old price, that is on 1st September, the price was 1000. On 31st December, the price has gone up to 1200 per metric ton, so the price went up, and the number of the tons, okay, quantity Q is okay, so let me create that. Q is 1000, so therefore the total value of the contract, total value of the futures is 2 million, and so therefore the value of the asset to be recognized is 200 million. So first is find the value of the derivative, then find the change, the previous date, the change in the value, it was 0, so therefore 0 minus 2000 minus 200,000 minus 0, and that is the change in the value of the derivative, which is not recognized in the income statement, but it is shown in the balance sheet as a part of the equity. So that is the accounting treatment on 31st December. Recognize the futures contract and recognize the changes in the equity, not in the income statement. On 31st January, that is the date on which the transaction happens, purchases the metal X, and that's also the closure of the futures contract, so you receive money on that. So what will happen to the financial statements? The financial statement will now look like this. So when I'm purchasing the metal, the purchase of metal, I'm purchasing for 1,200, purchasing for 1,200, quantity I'm purchasing 1,000 metric tons. So the purchase is, okay, so purchase is 1 or 12 million, 1.2 million, and that purchase is not an expense now because we are not selling that. So in the balance sheet, the asset will appear and there is a corresponding payment in the income statement. But at the same time, the futures contract closes, so the value of the futures contract which is there, because the price has not changed, I'm going to get that money now, and so the futures contract will close. So there is a receipt for futures contract, and on the balance sheet there will be no futures contract on the asset side because you have closed that and you have collected the money. And this is the net, or the difference between 1200 and 1000. The contract party has to give that money to A Limited. But important point to be observed is the unrealized gain still remains on the balance sheet. You are not transferring to the income statement because it is a cash flow hedge. The unrealized gain will be transferred to the income statement only when the metal X affects the income statement, which happens in this case on the 1st June. On 1st June, the goods are sold. So transaction number 1, sale of goods, transaction or accounting treatment of the unrealized gain to be transferred to the income statement. So what happens to the financial statements once again? So the financial statements on 1st June, you have, one is a sale. You sold that for 200 million. Okay, so there is a sale of 200 million. Sorry, 2 million, 200, and whenever there is a sale, there has to be a corresponding cost, and the corresponding cost of goods sold here, entire X has been sold, and as a result there may be profit or loss. But since you are selling the goods now, so the entire unrealized gain which used to be there from the reserves or from the what you call the derivative will be now transferred to the income statement. You see this, transferred to the income statement. So unrealized gain in the balance sheet will become zero because the entire unrealized gain is transferred to the income statement, and that is hedge accounting. So the unrealized gain on a cash flow hedge will continue to remain on the balance sheet till the corresponding hedge item is not transferred to the income statement. But the moment the corresponding X or the metal X is sold here, the corresponding gains or the losses will also be transferred to the income statement. To recap, in case of a cash flow hedge, whenever there is a revaluation, so the gains, first of all, you have to revalue the contract and show that as an asset, and the corresponding change in the value will be kept in the reserves or equity as an unrealized gain. And on every subsequent date, the forward contract will be revalued, and the change will be keep on adding to the reserves, and the reserves are transferred to the what you call the equity only when the item or the hedge item affects the income statement. Till that moment, you will not transfer the unrealized gain to the income statement. So, to summarize, the accounting for hedge items depends on what is the nature of the hedge, whether it is a cash flow hedge or the fair value hedge or the net investment. In all the three cases, the initial recognition is the same, but the subsequent recognition in case of cash flow hedge and net investment, the, the subsequent changes in the value of the derivative are transferred to the equity and then retransferred to the income statement, whereas in case of a fair value, that happens immediately. In our next session, we'll see an example on fair value hedge.